Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to answer the question, can I access my annuity money if I lose my job? Okay, so a little complicated in this situation. So I'm going to try to give you the best ideas possible. Number one, age is a factor in this scenario. Number two, the type of annuity matters. Number three, what kind of liquidity features do they have built into the contract? Okay, so let's talk about age. If you, well, first off, no, we'll start with the type, right? Because I think the type, if we're looking at just the accessibility, that's important. All right, so if you have a DIA, unless there's some sort of commutation benefit, you don't get to access it, okay? Commutation or return of premium benefit, right? So if you've got a DIA, and I would recommend replacing that DIA with something better because those products suck. But if you had that, call up the insurance company, ask for a commutation benefit or ask for a return of premium benefit. Everything else, fixed index, variable annuity, yeah, you should be able to cancel your contract or take a loan from the contract. Loans are rare, but it's definitely worth a phone call. But yeah, you can cash it in. You'll pay a surrender charge. Just know that. There are ways of getting around the surrender charge, or at least reducing the penalty, and I'll go over that in a minute. The other thing is that you have to worry about, and this goes into the age factor, which is if you withdraw money pre-age 59 and a half, not only will there be some sort of penalty from the insurance company, but there will also be a 10% early withdrawal penalty from the IRS. And that's a double whammy, right? So what do you do about it? Well, if it's a health-related situation, you might be exempt from that 10% early withdrawal benefit for some sort of health reason. So let's just say you lost your job because, well, you can't do the job no more. You're disabled or you're sick or you're ill. Okay, well, you may be able to look at a health-related crisis waiver on your annuity. So that's where the first place I would start. Usually annuities have a built-in waiver that'll allow you to waive all surrender charges for if you gotta go to a nursing home or you're in a hospital or assisted living for like 60 to 90 consecutive days. And that varies based on the annuity contract. So you got to check your contract. This is not across the board, but usually the rule is, hey, if you're in X facility or you're using X service for X amount of days consecutively, and you could show us that evidence, we will waive all surrender charge and let you access as much of your annuity without penalty as possible. Okay. Then on top of that, you want to see what the current IRS laws are. Usually there's some sort of like health-related exemption to the 10% early withdrawal penalty from the IRS. I'm not going to go over that in this video because tax laws change all the time. And when you buy an annuity, the contracts are locked in, right? So you want to look at the IRS for any sort of hardship exemptions to the early withdrawal penalty. Okay, so do that. If you lose your job just because you lost your job, I mean, some annuities might have an unemployment waiver in there. It's rare. It's worth a phone call. So what would I do if I had none of those things? Here's what I would do. I'd call up to see if there was a loan provision. Answer is probably no, but it's like I said, it's worth the phone call. And then what I would do is I would look at what my anniversary date is, and I would take out a 10% penalty-free withdrawal from my annuity, wait to the next anniversary date, take another 10% penalty-free withdrawal from, and this is sorry, this is going down a different tangent here. My ADD is kicking in. Not all annuities have a 10% penalty-free withdrawal. You gotta find out if you have some sort of liquidity provision. 10% is the standard if there is some sort of annual penalty-free withdrawal provision. So what I would do, going back, 10% penalty-free withdrawal, wait to the next anniversary date, The surrender charge would decrease after that anniversary date, and then take another 10% penalty-free withdrawal, and then cash in the rest if I need it, or take as much as you need. And that's probably the best thing to do. Is I wouldn't cash it all in at once. I would take it out as you need it, right? So if you're in between jobs and you need to pay rent, take out the 10% penalty-free withdrawal should take care of you for that month, maybe 2 months, maybe 3 months, right? I wouldn't just cash it all in, because you're going to end up paying, you might be paying a 10% early withdrawal penalty from the IRS on top of a surrender charge. And the way surrender charges work in annuities is that they decrease on an annual basis. So think of a 10-year annuity surrender period. First year is a 10% surrender charge. Next year's 9, then 8, then 7, then 6. So the longer you wait to cash it in, the lower the surrender charge would be. So I know that was a bunch of mumble, so I'm going to say it again. All right. If none of the waivers applied to me, I couldn't get a loan, I would take a 10% penalty-free withdrawal today, whatever my penalty-free amount is, pocket it, wait to the next anniversary date, take another penalty-free withdrawal, and then I would either cash it in, all of it or a part of it, and pay a surrender charge on it, or I would, if I can wait to the next anniversary date, that's what I would do, right? And the longer you take money out of the annuity via a withdrawal, the lower the penalty that you're going to get to your bottom line, right? So I know that was a lot. These videos are off the cuff. I don't want to do any sort of editing because they wouldn't be genuine. So if you got questions, leave it in the comments. I'll be sure to answer it in a couple of days. Like, subscribe, and we'll catch you on the next video. See ya.